Markets are currently up 5% this week. And a lot of people are asking themselves, what if I miss the bottom? Am I in trouble? Are there any opportunities left for me out here? Here to tell you and walk through my public portfolio and talk to you about what opportunities there still are right now if you haven't been buying the dip during this correction. On the screen right here, you see that we have my $10,000 High Five public portfolio account where I'm going to add $500 every single month. I'm building this account and I'm posting it on X consistently. I'm going to post YouTube videos about it. I'm going to walk through my buys, my sells. I'm going to walk through my portfolio management, all for free, all for the public to digest any way they want. And it's going to be a continuously going thing that I post about. So I'm really excited about this. I currently have a build out of 60% in tech, 30% in finance, 5% in consumer and travel, and 5% in health stocks. So we're going to go through these stocks one by one. We're going to be looking at what this is you're looking at right now. I'm going to explain it all to you. And then we're going to go through my High Five snapshots and why I believe that these are all stocks that you could start dollar cost averaging into right now. Even though it seems like the market's running away from you, you still have opportunities to buy this dip. You still have to remember we are still well off our highs of 2024 and 2025, friends. So without further ado, let's get into it. The first stock up here, my biggest position in the portfolio, and honestly my biggest position across all of my portfolios, private, community, etc. Meta. I love Meta. Meta is such an opportunity. It's one of the cheapest Mag 7 names out there. It's one of the cheapest big tech names out there. And their valuation is honestly just disrespected. This company has half the world's population using their apps on a daily basis. And they're moving into a ton of other opportunities with their Oculus, their smart glass, Ray-Bans, their LLMs, and their metaverse. So I'm really excited about Meta's future. And on the screen right now, let's just go over it before we get into all the deep dives into the stocks and everything. Obviously, we have our buys and sells here of our overall portfolio. Margin of safety percentage. I'll go into a little bit more when we go over into the High Five snapshot of Meta. But margin of safety is essentially saying if you believe that Meta is worth $600 per share, every little bit under that is margin of safety. The margin of safety percentage is based off what your fair value is. So if you believe that Meta is worth $600, right, and it's currently priced at $400, then you have a massive margin of safety window that you're buying deep in the value. You're buying deep valuation, right? So that's what margin of safety percentage is. It just goes off of by whatever you get your fair value. And I'm going to show you how we get our fair value here in a minute. Built position percentage. This just tells you out of the $10,000 portfolio, out of the weighting. So I have a 20% weighting in Meta and a weighting dollar amount of $2,000 because it's a $10,000 portfolio. And we currently have a $1,200 position built, 60% of my overall $2,000. And so how all this works essentially is I buy, not DCA, I buy off margin of safety. Now, there's nothing wrong with dollar cost averaging, but I found to not really time the market, but I like to buy in lots. And I like to buy in these lots when I know based off of my High Five snapshot and also based off of how deep a stock could go in a crash based off the charts as well. That's why my whole thing is, we're investing in trading meat. I use both my charting skills and my fundamental skills to find the best value, best companies, and best stocks to invest in for the long term. So how it works is I will buy 10% of my overall weighting, so 10% of my of $2,000 when we get to 20% margin of safety on any of these companies that are in my portfolio. And this is across the board. I use this across the board on all my investments. So for a total position of 10%, when we get to a margin of safety of 30% below fair value or intrinsic value, I will buy another 20%. So my full position is now 30%. Sorry about that. Is now 30% of the total 100% position or $2,000. Next, we go down to 40% margin of safety, which gets us, we buy 30% more, which gets us to 60% overall total position. And then finally, a 50% margin of safety. We would build out our last 40% buy, and that would get us to 100% of our margin of safety. You see that we're currently at 60% on our 3 tech companies. Meta right now, we're at 37%. We're at 60% because we did get to 40% margin of safety. Now that you know the layout of how I really do all this and why I'm buying, when I'm buying, and where I'm buying, now let's get into the High Five Snapshot of Meta. So Meta's High Five Snapshot here, pretty simple, guys. It's essentially a dollar discounted cash flow model. And then we have other criteria like free cash flow yield, forward free cash flow yield, PE, forward PE, and PEG ratio. Also, we have EPS growth rate down here and kind of get a nice realm of, if we keep growing with XPE with certain EPS growth rate down here, which I take the revenue growth rate here and the EPS growth rate here. I take those based off of analysts and I tweak them a little bit, either down a little bit or up a little bit, or keep them the same based on my personal views on the company and where they're going. So right off the bat, we have a 35% free cash flow margin rate for the next 1 to 5 years. And then we have a 39% free cash flow margin rate over the last 5 years of this total 10-year analysis. We have a 27 terminal free cash flow multiple, meaning at the end of 10 years, we would be paying 27. I believe that people would pay 27 multiple for the free cash flow that Meta will be putting out in 10 years. The revenue currently is 164.5 billion, 54.1 billion in free cash flow. Stock-based compensation is currently 16.7. They have a positive cash position over debt of almost 50 billion, and they have 2.5 billion shares outstanding. Now, some of the best numbers on this sheet, just getting to the brass tacks here. Free cash flow yield and forward free cash flow yield over 4% is phenomenal. Anything over 3%, I think is really, really good, especially for a big tech company, especially like Mag 7. PE and forward PE of 22 and a forward PE of 21. Also very, very phenomenal. Really, really good. I think you should be paying 25 to 30 PE for something like Meta for their growth and just, their overall moat in the world. And then their PEG ratio is below 1, which is also really good because they had a 25% EPS growth rate. And the main number that really, really matters, our current margin of safety is 36% because the intrinsic value, I believe the fair value of Meta today, now these will get updated after earnings here in a couple weeks. I do believe their fair value is $836. Fair value, not what people bid it up to. I think people could bid it up over $1,000, right? We see stocks run away from their valuation all the time. Palantir, Tesla, etc. So $836 is what I believe is fair value based on their free cash flow mainly, but also their PE ratio, their free cash flow yield, their PEG ratio. Those are also really good numbers that I really like right now. So what does this mean? Well, 36% free current margin of safety. That means if you were buying today and we hit these assumptions, so 20% revenue growth for last year, we get 15% this year, 14% next year, 12%, 7, 10, 10, 6, 6, 7, up till 2033. If you bought today, you would be getting, if you believe these assumptions, you would be getting a 14% annual CAGR. So you'd be getting 14% back on your money every single year for the next 10 years. Now, the market average for the S&P 500 is 8 to 10% per year. So you'd drastically be beating the market, which is what we were looking to do. If you can't beat the market, or you don't think you could beat the market, or don't want to put in the work to beat the market, then you should just invest in the S&P 500 dollar cost average every other week or every month in, every other week, in and out, consistently over years to come. And you would do very, very well. But if you want to be a stock picker and you want to make and beat the markets, you got to put the work in. You got to have a solid strategy. So 14% annual CAGR. This would bring us to about almost $2,000 per share in 10 years from now, up in 2033. So a little less than 10 years. And then for our EPS, we would be getting a 10.5% annual CAGR rate, and a terminal value of $1,442. So at the end of this analysis, we would also be beating the markets with this as well. So if you take the discounted cash flow model and the EPS model and mash it together, you're getting around like 12.5% CAGR percentage. So really good stuff. Really good stuff. And finally, to go over the EPS, we have a $23.92 EPS right now, 25% growth, and then just fluctuating 6, 15, 16, 8%, 17%, 14%, a negative 2% year, 10%, 8%, and a 12%. And just dropping down our PE in 10 years time to a 23 puts us around $1,442. The PE could be higher. I don't really think it could be much lower than a 20. And then, EPS could be way better. Meta's shown they can be really lean. They're spending a lot of money on AI right now, infrastructure. So yeah, we could definitely see better numbers on EPS growth rate. We could definitely see better numbers on free cash flow. But I do believe this overall analysis and my High Five Snapshot to be pretty conservative, and we get really good numbers. So this is number one on my list. This is one of my favorite stocks to be invested in right now for the long term. I just believe over the next 3 to 5 years, they're going to be $1,000 plus company, probably see a stock split. And then over the long term, 5 to 10 years, I believe they could get up to $1,500 to $2,000 per share, which would be a massive, massive increase from where we are right now. We're talking a 2x in the next 2 to 3 years, and a 3 to 5x over the next 5 to 10 years. So looks really good. Seeking Alpha has an F for valuation. This is not updated, so it's probably at least a D or a C, maybe even a B right now after, Mag 7, and this name is just completely plummeted. Sorry about that not being updated. So first and foremost, Meta, we have a 36% margin of safety. So if you were to follow my strategy here with margin of safety and buying, you would go ahead and buy 30% of your total overall position that you wanted to get built out today. Next up, Amazon. How easy is this? I mean, you're talking about the biggest cloud player. You're talking about the biggest e-commerce player. You're talking about a company that is now number three in ad revenue. I mean, they have Prime. They have the Prime subscription. They're getting Amazon. They're getting with Alexa and using AI. They have their own AI products. I mean, they have Zoox going in certain parts of the country now, which is like autonomous little vans. Really, really good stuff here, guys. I mean, Amazon's one of those no-brainers. It's one of the cheapest PEs that it's been in a very, 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 very long time. Very long time. So I love Amazon. It's my number 2 biggest position in this portfolio. And yes, these 4 are tied for biggest positions as they take up 80% of this portfolio overall. But across the board in my other portfolios as well, it's just a really big position for me. So we already talked about everything. Currently 60% built out position of $1,200 per share of this $10,000 portfolio. And rolling over into the High Five Snapshot, you can kind of see everything we talked about before, but this one, Amazon's free cash flow margin rate currently isn't the greatest, but I think they're going to continue to build on that and continue to increase that and start really printing that free cash flow as they start cutting back on businesses that don't really work. Because Amazon's thing right now, they're in such a growth mode, and they basically just threw out all their tentacles all over the place and are basically getting all the businesses, sticking their little sucker tentacles on everything that they possibly can right now, like most growth companies do with a ton of money. They do that, and then they see what sticks. Whatever sticks, and they pull back in to their octopus body or whatever, then those companies are going to be the core companies, which they already have their core companies, right? And then those other companies that they bring in that are going to be, great secondary core companies and secondary and third core companies, they're going to really pull those in and they're going to focus on those. Everything else is going to get cut like nothing. I'm going to be like, okay, chop this out, chop that out. We don't need that. That's when they get down to the refinement mode and they really sit there and they start saying, okay, what businesses aren't making money, what businesses are not going to make money, and what can we cut out to cut back on cost to really drive up free cash flow margin rate, overall margin rates, get us some more cash, and be a more efficient company. That's what I believe that is going to be the next phase of Amazon. They're still in that growth phase right now, and I'm completely fine with that. You know, e-commerce is going to continue to grow like a weed. It's just insane, guys. So yeah, I think they'll be able to honestly bring out their free cash flow margin rates over the next 5 to 10 years, even more than 8 to 13%. I'm just trying to be more conservative in case it takes longer than that, but I don't think it will. A 33 free cash flow multiple at the end of the 10-year analysis. Currently $640 billion in revenue. They're going to get to $1 trillion revenue in the next 2 to 3 years, honestly, maybe sooner than that. Free cash flow right now is $33 billion. 22 billion of that, 22 billion of that is stock-based compensation. So they have areas in there to improve as well to cut back on that. And current net cash positive over net debt of 47 billion and 10.6 billion shares outstanding. This one's not as clean and as obvious as Meta, in my opinion. You know, current free cash flow yield is under 2, which isn't the greatest. Free cash flow yield forward looking is 2.61%. So that's definitely a lot better than 1.68, you know, getting almost to 3%. I'm happy with that, with the type of growth that they have and, you know, the moat that they have. With current EPS, they're currently at a 30, almost a 34 PE, and forward PE is going to be almost around 29. And their PEG ratio is 0.42, so less than 1. And that's really good. They grew their EPS by 80%. I think they're going to continue to drive that EPS like I was talking about and probably beat a lot of these numbers down here, even 15, 20% EPS growth rate, a minus 20% year. I think they're going to beat these pretty handedly. And even if they don't, with a 25 terminal PE for EPS, you're still getting 9.5% return on your money. Buying today, and a 10-year endpoint of $462.28. And just looking overall, I believe the intrinsic value based on my chart here with pretty conservative numbers, guys. Like I said, I do see a lot of areas where they could do a lot better. Conservative wise, I don't see a lot of areas on here where they do worse. So that is being conservative and still having a 34% margin of safety and having a $283 fair value or intrinsic value. And current price today is $185.83. So I do believe this is a really solid company for a slew of reasons that we talked about. And you guys all know Amazon, and they're trying to be a worldwide brand and worldwide company. And I believe they're going to be able to continue to build on that over the years to come. So this did get down to 40% margin of safety, or no, it didn't get down to 40% margin of safety, $170. I don't think it did. Let me see. Nope, it did. It got down to $161.38. I missed the boat that day, whenever that happened, or those couple days or weeks or whatever. I did not get into it at 40% margin of safety. So, oh, sorry. Yes, I did. What am I talking about? Yeah, I have a 60% position built out. Sorry about that, guys. I just squirreled a little bit. Yeah, 40% margin of safety we got down to. We have a 60% overall position built out. We did not get down to $141.73. That's basically, you know, kind of like the lowest point that I think they could get down to before buyers step in. So we almost got down there, but we didn't. In August, we got down to 151, so close, but no cigar. This recent downturn, you know, we just kind of bounced off this. You know, if we do continue to go down further, we could get there. But I do believe that this 141 is the line in the sand. I really can't see us getting that much lower than where we were in 2021, 2022 highs. And I don't think we can get back down here during 2023 bear market, 2022 bear market. So yeah, I just think 140-ish is kind of that line in the sand. So yeah, very strong company here. To buy all over the place, 13.7% annual CAGR rate based on the discounted cash flow model with 10%. And again, pretty conservative growth numbers here as well, in my opinion. average growth rate is 9% over the next 10 years. They got a lot of businesses and a lot of areas to to grow in, and e-commerce as well. So as the world gets bigger, more connected, I think they can really reach out and do really well and have other investments, buy out companies, XYZ guys. Yeah, if you're looking for another company that's a great buy today, Amazon is that company. If you believe in this analysis and if you believe in these assumptions. Next company is Google. Wow, guys. Google is so undervalued. Have a 60% position built out in this name as well. I understand that LLMs are going to have an impact on Google. But the thing about Google is they still have the two largest search engines in the world. And I don't believe that's ever going to change. I believe they will always be number one in the two largest search engines in the world, YouTube and Google. And they have Waymo, which is on the streets right now, making money right now, continuously collecting data right now, and building and scaling across the United States with robo taxis, unlike Tesla, unlike other companies. So they have a lot of things in the pipeline as well. Obviously, they have a cloud-based company as well, like Amazon. I think they're number 2 to Amazon, maybe 3. It's them, Microsoft and Amazon right now. So yeah, got a 60% position built out here. Still a 35% margin of safety, guys. If you're looking for a company, Google is definitely another solid company that you could be buying today. Massive, over almost 4% free cash flow, forward free cash flow yield, a sub 20 PE, almost 17 forward PE on a Mag 7 name like Google that has the two biggest search engines in the world and that is number one in robotaxis right now. 20% free cash flow margin rate next 5 years, last 5 years 25%, terminal free cash flow of 30, revenue of $350 billion right now, almost 73 billion in free cash flow, stock-based compensation almost 23 billion, net cash positive over net debt of 22.6 billion, 12.23 billion shares outstanding with an intrinsic value of $244. Their current price today is $159. That is a massive 35% margin of safety. I was buying down here at around 146 with 40% margin of safety. 50% margin of safety would be all the way down here at around 120s. 115 to 130 would be our 122 would be our 50% margin of safety. And here's the thing, I look for the 50% margin of safety to honestly be the area that I believe that they're not really going to be able to get past. So lining up with this High Five Snapshot, this is where investing and trading meet, because I use the charts to tell me on a monthly time frame, okay, how low do I think Google can go? And really, I definitely don't think they can go under 100. And I really don't think they can go under 125 or at least 130. So I have this area right here as my 50% margin of safety. If people are dumb enough to sell me their shares of Google all the way down at $121 per share, I will complete the rest of my position of Google, will finish building it out, and guess what? I'll be a happy camper. And when this name is $300 plus, $500 plus, maybe even $1,000 one day, they're going to be kicking themselves in the butt that they sold their company to me for $121 per share. So $244 fair value, 14% CAGR based on the discounted cash flow model, massively beating the market. 12% EPS annual CAGR, beating the market again on the EPS here, along with a 0.52 PEG ratio, sub 1 PEG ratio. Again, just really, really good stuff. Conservative numbers, conservative revenue growth rate, conservative EPS growth rate, just left, right, and center, guys. And I put their 2035 PE at 16. That's like worst case scenario, guys. It again should be a 20 to 30, somewhere in between there, PE after 10 years, because I still believe that they're going to be dominant. They're not going to be as dominant in search, but they will still be very, very dominant. They have Gemini. They have a lot of good products. They have Waymo. They have a lot of areas that I believe they can cut costs at Google, and they haven't done it yet. We've all saw that Google video of the day in the life of a Google employee, where she went in and she didn't do any work. She didn't do no work. And, get her out of here. I'm a Google shareholder. If you're going to show up to work and not do work, bye. Sorry. See you later. So they have plenty of room to be cutting employees, to be cutting costs when times get tough. They just don't feel like now's the time. The times are tough. But that's something in their back pocket that I can see, that, yeah, when times get tough or they feel like they need to start cutting back on employees and, cutting costs, they definitely have plenty of room to do that. And I know they have these lawsuits and the potential Chrome spinning off and everything like that. It is what it is, guys. If they were to break up this company I'm going to get shares in those other businesses and I'll either hold them or sell them based on what I'm seeing here. But overall, until that happens, I'm good. And I'm not buying Google because of Chrome. Okay. So yeah, I love Google too. I think it's another solid company. And I believe that these three companies right here are your best bang for your buck in all of the Mag 7 companies. The best bang for your buck meaning that they're cheap. They have the cheapest valuations out of all the Mag 7s and a lot of the big tech. And they have the most room to run valuation wise to the upside, giving you the best return. And that is why such a small portfolio, like a $10,000 portfolio, is why I have them as my top 3 positions right now. Now, this video ran a little long, guys. We're at about 27 minutes. By the time I wrap it up, it's probably going to be 30 minutes. So what I'm going to do here is I'm going to say, we're going to stop the video here. My voice is getting a little raspy anyways. We're going to stop the video here. And this is going to be the tech portion of my overall reveal of my whole public portfolio. The next video you're going to see is going to be my finance, my 2 stocks that I have in finance. Will be my best 2 buys that I have been buying in finance right now. You see one of them, I got 60% built out, and the other one 30% built out. So in the next video, I'm going to be highlighting these 2 stocks, and maybe, we'll get through the rest of the portfolio, or maybe we'll do finance, then consumer travel, then health stocks. Might be a little series that we do, okay? Don't hate me. I'm sorry. I'm going to get these videos put together and built out. Bear with me. The reason I haven't made a video in probably over a week now is because I got sick, I got congestion, I lost my voice, that whole thing. So that's why I haven't been here on YouTube making videos consistently, making content for you guys all. Appreciate the support as always, though, everybody. I truly appreciate all the support, all the love, and across X, YouTube, everywhere that we are in the community, everywhere. I appreciate all the love and support you guys consistently give me, give my family when my kids are sick or something. I really appreciate that. I really value that as a human, and you're a human. I appreciate that on so many levels, guys. So I appreciate you all. If you want to follow me on my other socials, they'll be linked in my bio. They'll be linked in the comments. I'm on X, I'm on TradingView, I'm on TikTok. We have our community, our High Five community, where we do investing. We have this High Five community portfolio that we build. We have investing, we have trading, we have day trading, swing trading, long-term trading. We got it all, guys. Got strategies, indicators, got the whole 9. So we're doing really well with day trading right now. Had a nice four consistent days in a row this week of winning, and just phenomenal. I mean, we're pushing like a 20K plus week just this week, guys. And so many community members are pushing a couple $1,000s, tens of thousands, a couple $100s just this week. So if you want to consistently make money trading, or you want to get invested for the long term, come give the community a try. I'll link that in the bio as well. So I appreciate you guys sticking around for this video. Like I said, we're about to hit 30 minutes. Stay tuned for the rest of the portfolio series that I put out. And then from there, we'll just continue to update everything and, post about that pretty consistently, and any earnings or news around these companies, and when I buy and sell any of these companies based on margin of safety. And one thing I didn't mention, current margin of risk. Current margin of risk percentage, that's when I sell. So, all right, guys, appreciate it. I'll catch you guys in the next one. Have a great, amazing day. See ya.